Welcome to the 2024 DMI Halftime Report. Today, we're going to look at the market in 4 key areas. Here's a snapshot of the S&P 500 index performance from January 1st, 24 to May 1st, 24. The S&P 500 notched a solid gain, supported by a generally positive Q1 corporate earnings report and news reports about how artificial intelligence, or AI, was helping drive productivity gains. The first half was marked by 3 overriding themes: AI enthusiasm, inflation fears, and Fed signals. As monthly inflation reports gave mixed signals, the market looked for guidance from the Fed, which was balancing between how it planned to manage of inflation while acknowledging economic activity may lead to a change in short-term rates. During the first half, you may have heard the phrase Goldilocks economy, which suggests the economy was moving not too hot and a not too cold pace.
So, we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analysts' predictions for the year ahead. This image shows several projections shared at the end of 2023. How do these predictions compare to reality so far? The S&P 500 closed at 5,475 on June 30th, 2024. The S&P 500 closed at 4,770 on December 31st, 2023. Through the first 6 months of 2024, stock prices have exceeded what our 6 leading Wall Street firms have predicted. Even the most optimistic forecast in the table represents an increase in just under 7% for 2024, yet actual returns were over 14%. The outlet predicted expectations that the economy would likely run out of steam or inflation would reignite, which may result in a higher short-term interest rate. Predicting where the S&P 500 would be by the end of the year is always challenging, especially 2024, given the uncertainties of inflation, global economic growth, and central bank moves around the interest rates.
To create some context about where the economy may go in the second half of the year, let's start by looking back a few years so you can get a better perspective on how quickly outlooks can change. We picked January of 2022 as a reference point, since it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicator suggests, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve's monetary policy remained accommodative, and interest rates had not yet begun their climb from their historic lows. On virtually every important economic indicator, from inflation and monetary policy to credit demand availability to energy costs, it was flashing positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuation, and geopolitical risk. There were no negative indicators. However, these conditions would soon reverse. By January of 2024, just 24 months later, the outlook for the coming 3 to 6 months changed from guarded to optimistic. First, despite interest rate hikes from historic lows to historic levels during the first half of 2023, by the second half of the year, the Fed had started to slow down the pace of that tightening. And as you can see, 17 of the indicators were neutral at the start of the year, while 3 had slipped into the red: equity market valuations, international economic outlook, and geopolitical risk. Now, let's see where we are today.
Can you see the difference? Now, roughly 1/3 of the economic and financial indicators are positive, with only 2 negative: valuation outlook and geopolitical risk. Q1 earnings season helped boost the corporate profit outlook, and notably inflation, labor, and credit availability are among the indicators now in green. Consumer spending and consumer sentiment, along with housing, one of the most stubborn areas of inflation, have also swung to positive outlooks. This chart shows the relationship between S&P 500 performance and the 12-month forward earnings per share. As you can see, the 2 lines have generally moved in the same direction over the past decade, because the stock market is a discounting mechanism reflecting what investors believe the economy will look like 6 to 9 months in the future. Stock prices can, at times, change more quickly than earnings growth.
At the highest level, the Federal Reserve has 3 functions: 1, to provide an effective payment system for the U.S., 2, to regulate banking operations, and 3, to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with an inflation in the 2% range. The chart we're looking at depicts consumer price inflation on a year-over-year basis and on a month-over-month basis. As you can see in the chart to the left, there was an uptick in year-over-year inflation numbers in the first quarter of 24, which is one reason why the Fed is being cautious about changing course with interest rates. That Q1 increase was followed by a modest decline in April. The consumer price index remains above the Fed's 2% target inflation rate. Expect the Fed's decision on monetary policy to continue to influence the financial markets through the second half of the year. The labor market continues to demonstrate its resilience despite questions about the economy. This vitality has provided an important support to the markets since having a job is foundational to consumer spending, which helps drive economic growth. This strength may be best illustrated by two labor market measures: the unemployment rate and current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring by private sector employers. Even in the face of this robust hiring, the percentage of companies unable to fill open positions remains quite elevated despite falling off somewhat over the past 12 months. But by these two historical measures, the labor market appears healthy.
The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the United States each month. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because the consumer spending accounts for more than 2/3 of the gross domestic product, or GDP. As the chart indicates, consumer confidence has continued to recover from historic lows in June 2022. The chart shows that the sentiment has been on the general upswing since 2022. Artificial intelligence has been a market buzzword for the past couple of years. And to keep investors updated, S&P 500 companies are provided updates as part of the quarterly conference calls with investors. As you can see in the chart, in Q4 2023, AI was mentioned on earnings calls for 179 times as investors want to hear from companies about their plan to use the newest technology.
Let's take a moment to consider the variables that may weigh heaviest on market performance. The first factor, inflation. If it remains where it is presently, then it may influence the Fed's decision on short-term rates. Recession is still a possibility. However, the U.S. economy has remained resilient, raising hopes for a soft landing. And if the economy slows too much, the Fed stands ready to cut rates. Artificial intelligence. It continues to be a driver of stock market gains, particularly when companies discuss AI adoption into their operations. Greater efficiencies, focused capital spending, and continued positive consumer sentiment are factors that would push companies to explore AI opportunities. To gain better insight into how economists think the economy will perform, we took a look at the May 2024 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Let's look specifically at consensus forecasts for three key areas: GDP growth, unemployment, and inflation. The consensus view as of May 2024 is that the GDP growth is expected to be between 1.5% and 2.4% in 2025. Unemployment rate remains low at between 3.7% and 4.2% in 2025. And core personal consumption expenditures, or core PCE, to between 2% and 2.4%.
Some market strategists look at the bottom-up earnings per share to help them set their price target for S&P 500 index. When setting a bottom-up earnings per share, market strategists focus their attention on estimating earnings for all S&P 500 companies. This chart, notice how stock prices have been trending flat to higher while corporate earnings are more mixed. When evaluating this chart, it's important to remember that the stock market is considered a discounted mechanism, which means that it's always looking forward. Put another way, the stock market price today represents all available information about current and future events. How far is the stock market looking today? Most would agree it's discounting activity 6 to 9 months in the future. So are stock prices seeing a turnaround in earnings? That's uncertain, and only time will tell.
The big question for investors, what can we expect for future corporate earnings? Stock prices have trended higher in the first half of 2024 despite mixed reports on earnings. Market analysts expect all 11 stock market sectors to show earnings growth overall will slow up a bit in 2025. If you take a look at the chart, you'll notice that the earnings for 6 out of the 11 industry sectors of the S&P 500 are expected to grow with compared to today. Near the center of the chart is the overall earnings growth projection for all S&P 500 companies, estimated to be 14.2%. Some sectors are expected to do better, while others are expected to lag. Future progress on inflation may be a bit more difficult. One aspect in particular is sticky inflation. Sticky inflation refers to the components of the CPI, or Consumer Price Index, that have historically exhibited a greater rigidity or stickiness. In this chart, the 12-month sticky inflation line is orange, while the 12-month CPI line is gray. Sticky inflation includes many service-based categories, including medical services, education, personal care services, as well as most of the housing categories. Fed Chair Jerome Powell has often referred to stickiness in service-related inflation as one reason for remaining vigilant in the Fed's fight to lower inflation.
Will the Fed adjust interest rates before the year end? The next 3 meetings of the Federal Reserve Open Market Committee are September 17th and 18th, November 6th and 7th, December 17th and 18th. Typically, if the Fed is going to make an adjustment to interest rates, it will announce the changes following the 2-day meeting. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, existing bond prices go down. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a change in tide in the economy doesn't mean you have to abandon a fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need.
We've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. After a very disappointing 2022, frustrations were high. But since late 2023, stock prices have been trending higher. This chart shows an analysis of bull and bear markets during the period from May of 1970 to March of 2024. In it, you see the average bull market lasts nearly 76 months, while the average bear market runs a little over 15 months. As we can see above, the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over the long term. The next point I'd like to convey is a cautionary one on the temptation of getting caught up in exciting new investment themes. As you can see, faddish themes have occurred fairly regularly since the 1970s when gold rallied higher, only to trend lower. These trends can develop into broad markets, for example, Japan and Asia in the late 80s and 1990s. Or they can form into certain asset sectors, such as internet or biotech companies. The enthusiasm for artificial intelligence, or AI, started in late 2022 and continues to grow today. And what I want to emphasize is the importance of following a long-term investment strategy and not get sidetracked by fads. Does AI offer the potential of meaningful capital growth for investors in the years ahead? It might, but there are always ways to incorporate AI into an investment strategy that takes into consideration your goals, time horizon, and risk tolerance. And that concludes DMI's 2024 Halftime Report.